Welcome back, everyone. Let's jump straight into today's explainer. We are diving into a seriously fascinating intersection where human psychology, high-stakes finance, and the seemingly random world of sports betting all collide. If you've ever wondered how the exact same mathematical forces governing complex Wall Street algorithms are also driving weekend football wagers, well, you are definitely in the right place. We're going to explore how data, our own irrationality, and the relentless search for an edge connect everything from late-night pizza deliveries to major geopolitical events. It's an incredible look at how we value assets across the board. So, let's get into it.
To really understand the absolute extremes people will go to for a statistical edge, we have to start with a wild story from the prediction markets. Let me ask you this. Can a slice of pizza actually predict a geopolitical strike? I know, it sounds totally absurd. But in the world of high-stakes information gathering, unconventional data is absolute king. This brings us to the now legendary tale of the Pentagon Pizza Bot. It's the perfect proof that sometimes the most valuable market signals are just hiding in plain sight, or, inside a cardboard delivery box. And this story brilliantly illustrates just how incredibly lucrative those weird signals can be. So, get this. A trader on a prediction market, going by the handle Sweet Cheeks, supposedly pulled in an $80,000 profit in a single night. How? They built a bot specifically to track late-night Domino's pizza orders near the Pentagon. The logic is actually super simple, but completely ingenious. A ton of pizza being ordered at 3 or 4 in the morning means Pentagon staff are working some serious, intense overtime. When the bot flagged a massive spike in those orders, Sweet Cheeks immediately bought shares predicting a U.S. strike in Venezuela. The strike actually happened, the market resolved, and boom, the bettor walks away with 80 grand.
Now, the underlying engine driving that massive payout is a concept called information asymmetry. In literally any market, true outsized profit only happens when you know something that the rest of the market doesn't. We actually saw another jaw-dropping example of this recently on a platform called Polymarket. Out of nowhere, a newly created account dropped $30,000 betting on Nicolas Maduro's exit from power. Literally overnight, the U.S. took Maduro into custody, and that same trader cashed out with a $400,000 profit. So whether it's a clever pizza bot or highly suspected insider trading, holding early asymmetrical information is just the ultimate edge.
All right, moving into Section 1, Markets Mirror Sports Betting. To really grasp how this all connects, we're going to anchor things with some brilliant research from Yale's Tobias Moskowitz. He points out something really interesting. In traditional financial stock markets, prices get totally muddled by massive macro-level risks. Think inflation, changing interest rates, shifting global supply chains. It is genuinely hard to tell if a stock tanked because the company itself messed up or just because the Federal Reserve suddenly changed policy. But the sports betting market, Moskowitz actually calls it a clean laboratory. A football game doesn't care about the price of oil. It's a completely closed system. We can perfectly observe how people are pricing a specific asset, a betting contract, and then objectively see if they were right or wrong the second the clock hits zero. And that clean laboratory leads us straight into the fascinating world of behavioral economics. This is the study of how our inherent human psychology, all of our weird flaws, and our natural irrationality actually drive market mispricing. See, in a perfectly efficient market, prices would reflect all available information flawlessly. But behavioral economists know that humans just aren't perfectly rational. We overreact, we have deep-seated biases, and we let our emotions take over. So whether you're a value trader hunting for an underpriced tech stock or a sports bettor looking for a mispriced point spread, your edge ultimately boils down to identifying and exploiting the irrational behavior of everybody else. Which brings us to a really specific finding from Moskowitz's study that mirrors Wall Street perfectly. He found that sports betting contracts show incredibly strong momentum effects. As he puts it, if you look at teams that have done well recently, bettors overprice those teams. It's literally the exact same thing on Wall Street. Momentum traders buy stocks that are already surging, just betting that the public will keep blindly driving the price higher. In sports, bettors do the exact same thing. They aggressively chase recent winners and consistently overpay to back underdogs. They let their recency bias completely cloud their mathematical judgment. Let's jump over to Section 2, Systematic Trading and Quants. So, how do the absolute pros remove that messy human emotion? Well, they rely on platforms like Quantitative, which literally strip hundreds of dense academic papers down into pure systematic algorithms. Breaking down these numbers really shows what a legitimate data-driven edge actually looks like in practice. Take the time series momentum effect across bonds, commodities, and equities. That's pulling an indicative performance of around 20.7%.
Or consider the payday anomaly in equities, which exploits very specific daily seasonalities for a roughly 2.5% return. The key here, these aren't gut feelings. They are rigorously back-tested, mathematically sound strategies executed over years, totally devoid of the psychological traps that Moskowitz found in everyday bettors.
Which naturally leads us to section 3, the myth of fake edges. Because listen, for every single true edge out there are probably dozens of fake ones just waiting to drain your wallet. Over on the Circles Off show, some pro bettors totally dismantled a few of these fake trends that always seem to go viral online. For example, the idea of fading a social media personality, like Book It with Trent just because he happens to be on a 4-game losing streak. Mathematically speaking, point spreads are coin flips. Over a large enough sample size, nobody's going to lose consistently enough to make blindly betting against them a profitable long-term strategy. Or what about digging up hyper-specific referee stats, like claiming a certain ref always favors the favorite, but wait, only when the over-under's above 44? Guys, that is just classic data mining. If you slice a small sample size enough different ways, you are absolutely going to find a correlation eventually, but it's totally meaningless noise. It is not a predictive edge.
Another incredibly dangerous myth is the idea of betting against late market movements. Professional bettor Steve Fezzik was on a podcast recently suggesting that you should just find the biggest line movements right before a game starts and blindly bet the other side. But as the experts on Circles Off quickly pointed out, that advice completely misunderstands how market efficiency actually works. In those final moments right before a game kicks off, the market liquidity is absolutely massive. The millions of dollars moving those lines, that's not coming from amateurs. It is coming from massive NBOS syndicates running the sharpest predictive algorithms on the planet. Trying to blindly outsmart the absolute most efficient point of the entire market is basically a coin flip. Definitely not a mathematical strategy.
All right, section 4, the reality of risk.
Okay, so let's say you do everything right. You find a real edge and you actually start winning. Are you suddenly rich? Well, not necessarily. There are some incredibly frustrating structural roadblocks out there. Take this real-world case involving a DraftKings user who goes by Bitcoin Motorist. He successfully won a promo called King of the Court, which awarded him 20 separate $50 bonus bets. Sounds awesome, right? But when he logged in to actually place those wagers, he found out his account had been heavily restricted. The sportsbook artificially limited him to a maximum bet of about $4. And because the rules of the bonus dictate that it has to be played in a single $50 chunk, he literally could not use the prize he fairly won.
What the situation perfectly exposes is the deeply siloed, behind-the-scenes mechanics of this industry. These departments are operating in entirely different worlds. On one side, marketing is running these flashy, massive contests and giving away prizes just to drive up user engagement. But on the other side, risk management and trading are constantly sweeping user data to identify and essentially throttle anyone who looks like they might actually have a real edge. The left hand has literally no idea what the right hand is doing. And the result for the user? A structural roadblock that basically acts as false advertising, guaranteeing that even if you beat the game and win the contest, the house physically prevents you from cashing in. And that brings us full circle right back to Yale's Tobias Moskowitz, because his ultimate conclusion was honestly a pretty sobering one. He realized that even if you're an absolute genius who can perfectly spot behavioral flaws and mispricing in the market, the structural limits and the VIG, meaning the built-in transaction fees and commissions taken by the bookmakers, make long-term profit incredibly difficult to sustain. The friction of the market itself is mathematically designed to just slowly grind away your bankroll, regardless of how clever your pizza tracking bot might be. So what's the real takeaway for us here? Whether you're day trading equities on Wall Street or throwing down on a Sunday point spread, the search for an edge is a total battlefield. It's a mix of human psychology, hardcore data analysis, and massive structural barriers. You have to constantly be challenging your own assumptions. You really need to ask yourself, are you actually finding a true systematic, mathematically driven edge, or are you just falling for another slice of random behavioral noise? Definitely keep that in mind the next time you're about to put your money on the line. Thanks for joining me, and we'll see you in the next explainer.